Today, the SMS is very pleased to have Josh Barron, a partner with BanyanGlobal, join us to share his views on the competitiveness of the family-owned business in the 21st century. Josh's CV was included in your invitation to today's session, but I'd like to add a couple. He is a founding partner of Banyan and has extensive experience in helping owners of family businesses in North and South America, Asia, and Europe. Josh is a thought leader and a prolific writer and speaker on the issues of family business ownership. He also teaches at the Columbia Business School. Josh is also a great all-around individual, so please feel free to contact Josh. We are lucky and excited to have him join us today for the Strategy Innovation Forum. Josh?
Thank you, George. And thank you to Will and Anna and the Strategic Management Society for this opportunity to spend some time with you all today. Thank you for those who are attending. I saw a few familiar faces, or names at least, and looking forward to sharing some ideas and having a dialogue with you about a topic that's very much close to my heart, which is the ways in which family businesses can actually create sustainable competitive advantages. I want to actually start by talking about a non-family business, one that made waves a couple of years ago on a topic that's related. You may remember there was a tweet storm and discussion when Elon Musk, the founder of Tesla, started talking about the challenges of being a public company. And in fact, how it was a major distraction for everyone working at Tesla, focusing on this quarterly earnings cycle, making decisions that may be right for the quarter, but not for the long term, and not allowing them to focus on what they do best, which is building these incredible cars. And what's interesting is that Elon Musk is certainly not alone in complaining about the challenges of being a public company. A few years back, Fortune 500 and their annual survey asked Fortune 500 CEOs about whether it's be more easier or harder to be a public or private company. And almost 85% said it would be easier to manage their company if it were private. Talking about all the technological change that's happening, and which requires long-term thinking, smart investment, but instead public shareholders are demanding short-term results. And public company CEOs are caught in the crosshairs. So what's happened here? How have public companies become sort of challenged in dealing with some of the strategic issues and dynamics of the day? Well, I first want to just go back a little bit into history and just talk how did public companies become so dominant in the first place? Because they weren't. If you look back 100, 150 years, there were very few of these large public companies. It's important to put this into context, which is that the 20th century saw really, if you go and look historically, an unprecedented period of economic growth, one that we hadn't seen before and really, frankly, may not see again. And as part of that, the sources of competitive advantage for companies really favored things about size and scale. Mass production really started to come around for the first time, thinking about assembly lines and things like that. Integration of companies. If you wanted to offer a product or service, you had to do it all the way from beginning to end. So for example, Ford Motor Company actually raised sheep for the wool that they put inside the seat covers. So if you wanted to build a company, you had to do everything end to end. There was a big focus on protecting the companies that were already emerging competitors in their sectors. Then there was this focus on diversification. If you remember the movement from the 50s and 60s, this is before individual investors could diversify on their own. Companies started to do that. Think about like ITT buying hundreds of different companies as ways to diversify. And then we had the whole move international, where companies, especially from the industrialized world, started to go abroad. And of course, if you wanted to have operations in another country, you actually had to send people there and build up those offices and staff. What those things all have in common is that they created a race to scale, where the strategic priority was to get as big as possible, as quickly as possible. And what's notable about that is that this actually is something that public companies were ideally suited to do. They were sort of designed to be able to address this need for the massive amounts of capital required to grow in this way. And they dominated. This is a great book called The Company that goes through the history and rise of the public company, which I highly recommend. one of the things they note is that by World War I, this giant corporation had become the dominant business institution in America and globally, and became the standard by which all enterprises were judged. And really the only way you could beat one of these large companies was by being another one, not by being an upstart. And just to note that they said a list of America's biggest companies in 1970 would have seemed fairly familiar to JP Morgan, who died in 1913. There just wasn't a lot of change, disruption, going out of business. Once you reach that size and scale, there is a strong ability to stay there. Now, those are sort of the halcyon days of the public company. And what we've seen since is actually at least a relative fall. Of course, they're still dominant in many sectors. They're still the companies that we talk and think about the most, but their actually share of what's going on in the economy has actually declined. And there's, again, another fascinating book, especially for those interested in strategy, called The Lords of Strategy, that sort of talks about the evolution of competitive advantage across time. And the author talks about these four horsemen of the corporate apocalypse, these mega trends that really affected companies in profound ways, with deregulation and new technologies coming in, the opening of capital markets, which created this real market for control, which has really had a big impact on forcing companies to focus more on their shareholders. And competition has really exploded. It's not just from a few places, but now it can be from anywhere. And all these trends really opened up a wave of creative destruction that undermined the dominance of the largest public companies. And we actually saw some of this decline in the last part of the 20th century. The biggest firms grew more slowly, the economy as a whole. Those that make it onto the S&P 500, if you did that in 1958, you'd expect to stay there for about 6 decades. It's under 2 by 2012. BCG did an analysis a few years ago about public companies, and they're facing a 5-year exit risk. So how frequently do companies disappear over 5 years? Used to be about 5%. Now it's closer to 1 out of every 3. And the fundamental problem, that we're that we're wrestling with is that what public companies were designed to solve is no longer the determining factor in most industries, and that's access to massive amounts of capital to build these enterprises. And one of Bain kind of noted that the skillful allocation of financial capital is no longer a source of sustained competitive advantage. It doesn't mean that it's not helpful, but it's not the single most important determinant to success in this economy. So, and that's really what gets us into context for the conversation I want to have today, which is not really about public companies, it's about family businesses. But the reason why this context is important, because it points out that family businesses were actually at a disadvantage when the imperative was access to massive amounts of capital for rapid growth. And that same book about the history of the public companies points out that a lot of family firms were just too small to thrive in a world that was dominated by scale and scope. And a lot of them, to survive, actually had to issue shares to the public in order to get enough money in order to compete with some of the other companies. But what we're seeing, at least what I'm seeing, is that this competitive context that really favored the public company, that favored its rapid rise to dominance, has actually changed. That there's less value in these scale-up strategies. And not to say that it's not helpful to be a bigger company, but the ability to go from small to big to bigger, faster, is less valuable in most sectors than it was back 30, 40, 100 years ago. But at the same time, there's a tilt away from some of the things that family businesses struggle with and towards areas where family ownership brings a potential advantage. I like to think of the analogy of the tortoise and the hare. It's not that family businesses can't win or even can't get big. You see some mammoth family businesses, ones that are 20, 30, $100 billion in revenue, the Cargills and the Mars and the Tatas of the world, but they get there in a different way. It's not over a few years by going public and getting massive amounts of capital. Usually it takes decades. It's a sustained reinvestment cycle of a different path to this dominance, more like the tortoise and the hare. So how do we understand this change in the competitive dynamic and the way in which it is affecting family businesses? To see it, we actually have to talk about a subject that is really not that discussed, I found, in the field of competitive advantage and strategy, which is the topic of ownership. And the reason why ownership is so, is so helpful to understand that is because it's something that is often hidden in discussions about strategy. This is sort of the classic pyramid that we sort of think about for a company. We have our employees, we have our managers, we have the CEO at the top. The CEO usually answers to the board, but oftentimes the CEO and the board chair are the same person. And this, virtually all of those who are studying, advising companies are focusing on this pyramid, on the impact of the CEO, CEO down, CEO and management. But what's important to note is that this is just one model of running a company. It's the public model where executives rule and owners exercise their influence mainly by selling shares. Otherwise, if I'm an owner of a public company, I don't have a lot of ability to influence what's happening in the company, except maybe by the occasional activist action. And the effect of ownership on business successes is largely ignored. I teach at a business school. We don't really teach ownership. We teach management, a bit of corporate governance. In family companies, this could not be more different. Instead of being people who are trading shares on apps or investing in the entire stock market, the owners are actual people. They're actually on the top. This is the hidden pyramid. They're actually on the top. And because of that, because ownership brings with it a significant amount of power when it's not just delegated indiscriminately down to the CEO, it brings an ability from the ownership to influence the business in some profound ways. And I just want to highlight a few ways, and we're going to focus on one of them. One is that family ownership actually brings the power to destroy, to take a very successful business and almost bring it down in a matter of sometimes days, weeks, or months. And these are actually the stories that we sort of read about family businesses because they make great drama. I mean, in some ways, they make great actual TV shows like Succession or Dynasty in Dallas before it. Some of it's even stranger than fiction. Some of the stories of what families do to each other. And these are the things that really we kind of focus on in family businesses. In my life, in my world, working with family businesses, actually, what I see is actually much more of a different power, which is the power to sustain a business over a longer period of time. Family businesses are sort of tagged with this idea they don't make it across generations and so on. But the reality is that most family businesses, most of the longest lasting businesses in the world are actually family companies. And there's something unique and different about what family businesses can do to sustain themselves across generations. It's actually the subject of a book that a colleague and I have coming out in January. So if you're interested, you're curious more about how you do that, you can definitely pick that up. What I want to focus on today, though, is another power, which is actually the power to compete. That family ownership in particular actually brings with it the ability to do things that other companies can't. And those things are actually much more valuable now than they were before. And the things that family companies are good at are actually trending in the positive direction. The things that family businesses are not as good at are actually going in the opposite way. So to sort of talk about this, we need to introduce this notion of how ownership actually creates a competitive advantage. And this is something that I got interested in because over the course of my career, I've been a strategy consultant. I worked for Bain & Company. I worked for a spinoff of Bain that works with nonprofits and foundations. I've been working with family businesses for almost 15 years. One of the things that I've noted is that different types of businesses operate very differently. And if you translate that, actually, we can see is that how a company is owned actually affects its ability to create competitive advantage, what it's good at, where it struggles, the kinds of opportunities that it has, as well as the kind of threats that it faces as a company. And what we'll see is that the type of ownership influences the building blocks of strategy and therefore shapes the ways in which companies can compete. And because these broader trends affect how strategic levers are favored or unfavored, then what happens is that as these changes happen, then different ownership models become more or less able to compete. So it's not a static picture. I'm not saying this is a permanent trend, just that this is the direction in which the world it seems to be headed. So how is it that ownership can actually affect strategy, competitive advantage? And I'm on this call with a bunch of people interested in strategy, so we all probably have our own definition of what strategy means. I'll give you mine, which is that strategy is about allocating resources to create competitive advantage. And if that's the case, then a difference in strategy could come from two main sources. Either companies, because of their ownership structure, have different access to capital, the resources available to them. And we can think about human capital or talent, financial capital or investment, or social capital. What's your reputation? So different kinds of capital that you can have available. Or you can make decisions in a different way. Your quality of allocation can be different. And I'll separate between management decisions, which are the day-to-day of sort of running a business, versus governance decisions, which is the interconnection between the owners of a company and the managers. How are decisions made for management to sort of act or not act in the interests of owners? And what I've found in my experience and doing research on this topic is that ownership actually shapes both of these. It shapes both how companies can access resources, as well as how decisions are made across all of these dimensions. And so what I'd like to share with you is actually go one by one and talk through for each of these 5 boxes that you see here. What is the strategic imperative that all businesses are facing, family, non-family, and so on? How is it that family ownership actually allows these companies, allows family businesses to at least potentially create a strategic advantage? It's not inherent, it's not guaranteed. And that's what I want to also talk about is, what are the actions that you can take to either activate that advantage or sustain it if you've already developed it, which many of you on this call have. So let's start with the first one, is the idea of talent or human capital. And the change actually has been from the focus for a long time, for decades, was creating these very large companies with massive employment, and sort of how do you manage all of that sort of size of large workforces, hundreds of thousands of employees. This was the era of the company man, where someone got a job and stayed there for an indefinite period of time. We've seen actually a change, though, where it's less about having these massive workforces, about the number, and more actually about how do you inspire your employees by making clear not just the fact that the company is a good place to work, it has a great job, but there's some intrinsic value of working for your company, what I would call a higher calling. How do you actually inspire people? And as Bain noted, that inspiration, this is for all companies, is essential for attraction and retention of the best talent. And in fact, if we sort of look around sort of some of the major trends in management, it's trying to figure out, how do we get people to engage? There's all kinds of studies about how unengaged many employees are. How do you actually do that well? And there's some good research that shows about the impact of high employee satisfaction, that those with that are actually outperforming their peers in terms of long-term performance. So actually, this is something, huge payrolls and so on, with all the complexity that comes with that, not necessarily an advantage for family businesses, but in terms of actually inspiration, this higher calling is a real place where family businesses can have an advantage. One of the things that I see all the time in my work is that you hear family business leaders talking about long-term investments in people. And that's true when you have a downturn like COVID. One of the first things that public companies do is lay off employees to try to reduce their payroll. It's one of the last things that family businesses do. They really think about the capital and the people having a long-term connection to them, a loyalty to them that sort of lasts through upturns and downturns. We hear a lot today about values-based cultures and purpose-based cultures and all those things. I think this is something that public companies can do. There's certainly some good examples of ones that do it, but this is an easy thing for family businesses to do. And that's because the family is a source of our values. And across generations, the family can actually be the carrier of company values across the decades of a business. There's also just a loyalty effect of working with the owners. I see this all the time. People actually like working for the owners of a company, and that gives them a higher level of satisfaction, because you can go and say, well, I have this big idea, or I want to make this change, and the owner can say, that's it, let's do it. So it actually brings a level of satisfaction. And of course, family businesses are able to grow their own talent pool. You have people that have been oftentimes growing up in the business, going to the office from the time they were kids, and by the time they're in their 20s, they feel like veterans of the industry. They know the ins and outs. It's in their blood, in their DNA already. Oftentimes they go to the best schools, get great educations, great job opportunities. You can actually grow a significant family talent pool. And just on each of these, I'll try and share both a little bit of the evidence as well as some examples. I've disguised them for confidentiality, but all of these are real quotes or conversations from family business leaders. So McKinsey, has done some research, which is echoed in other research, that family firms scored significantly higher on things like culture, worker motivation, leadership, lower rates of absenteeism, all kinds of things that sort of point to family employees being more motivated, more engaged. And this is a quote from a leader of a family business. He said that the beauty of a family business is that you can invest in your employees and take a long-term view of employee retention. He said this is a built-in advantage that public companies can never have. They actually measure their employee retention. He says it blows away that of our competitors. So that's the potential advantage. How do you actually activate it? Well, first of all, you have to actually talk about what is your culture. You actually have to try to articulate why is it that you're in business, and communicate that to employees so they understand. It may be sort of stuck inside, but not really very clear. Of course, measuring things like employee retention and engagement, realizing this is a source of advantage, making sure that it's not slipping over time as you make different changes. One of the things I see all the time in family businesses is that, yes, you can hire outside, but it's even better to build your own leadership pipeline, which oftentimes means creating great HR systems, which sometimes is more of a struggle for family business leaders. Using long-term incentive plans, such as phantom stock or simulated equity, you can do things that mimic ownership without handing over any actual control. And that helps to align incentives and create, sort of a push behind the common goals. Play to your strengths. And sometimes you hear that, family companies struggle to recruit talent because the people know that they're not going to be able to reach the CEO spot, and which is not always true. I think this can be overstated in any pyramid. Only one person is going to rise to the top at any one time. So instead of focusing on what you can't do, focus on what you can deliver, which is a culture that is different, that's more long-term oriented, more employee friendly. And then lastly, it is important to actually build that family talent machine, while avoiding, nepotism is actually, having family members work in a business can be great. In fact, there is nothing better in my experience than a family business led by a qualified family member. But unqualified nepotism, people are there just because they're part of the family, can actually sink a culture pretty fast. So those are all things, I'm sure you have other examples of things you can do to actually build out this first advantage. The second one I want to talk about is the actual investment capital, financial capital. And I talked a lot already about how the priority before was getting access to other people's money. And this was the thing that public companies are really good at, is getting access to equity capital and debt capital. But I think the priority has actually shifted from the quantity of capital to the quality of capital, what I'll call committed capital. And the strategic imperative that companies are facing is, how do you build an equity base that's dedicated to long-term results as opposed to quarterly earnings targets? And this is something that struck me when I read it, but there was a study of public company CFOs who were asked, would you make a decision that destroyed value, financial value, in order to achieve your quarterly earnings targets? And 78% said yes. The other 22% are probably looking for a job, because that's the pressure that's on public companies to achieve their quarterly earnings targets. And again, McKinsey's research has shown that companies with a true long-term mindset have consistently outperformed their peers across almost every financial measure that matters. And again, this is something that family businesses have a huge advantage of having this capital that's kind of there for the long term. And in fact, if you play it right, family businesses have this very low cost of capital. You could think about it that one of the, when you go and talk to your estate planning attorney as a family business, the thing that they'll tell you is you should be pushing the value down as quickly as you can, because if you have a estate tax in your jurisdiction, then the more the business appreciates, the harder it is to pass it down from one generation to the next. If you're doing that, then you could think about it that your capital basically is interest only as opposed to principal. You never have to pay it back. The principal keeps appreciating and passing down through the lines. You're just paying out dividends in order to keep people interested and involved. That, if you do the math on that, that's a pretty low cost of capital. There's also just a limited marketplace for shares. So even if people want to sell, it's not so easy to do that. Most family business shareholder or buy-sell agreements have restrictions on sales. There's also valuation discounts that are built in as high as 40 or 50% of the value, which creates a disincentive to sell, an incentive to try to hold on. There's also a conservative approach to finances that's built into family businesses. You know, the idea of loss aversion. You're much more careful with what you already have than what you might stand to gain. There's also a very strong control bias in family businesses. They want to stay in control over decision making, and to do that, they're very, very careful about either, you know, almost never bringing in outside equity partners, except very thoughtfully, as well as debt. You know, most family businesses, you know, are very careful about borrowing money. And to the point where I was actually talking to a family business leader who had just attended a week-long Harvard seminar about finance. And he said, I felt crazy because everyone was telling us we should be borrowing and borrowing because it's tax efficient, because it, you know, ups your return on invested capital. He said, that just doesn't make sense to us. I mean, we basically understand that if you borrow money, then, you know, it comes with strings attached, and people are really willing to lend you money when you don't need it, not so willing when you do. And those covenants can actually be a significant problem, can actually force the company to go out of business. I just want to note a couple of notes. George Stalk is one of the, you know, the gave me the generous introduction. One of the most thoughtful, insightful strategists around, and he and some colleagues did a study of family versus non-family public companies. And what they found is that in good times, family businesses don't do as well because they're not leveraging up, and some other reasons. They're more conservative. In downturns, they actually outperform non-family businesses. And if you look across a business cycle, the average long-term performance is actually higher for family businesses. That really is this built-in effect of what can happen with capital that's focused on the long term. And I love this quote from another leader. We control our own destiny. We are just as greedy as anyone else out there, but we are long-term greedy rather than looking to make a quarterly return. We're able to make decisions based on what is in the long-term benefit of the company. And how do you sustain this sort of committed capital? Well, I mean, first of all, you have to make sure that you're actually setting goals and putting in place some guardrails that connect to long-term performance. So, you know, measuring your results over like a 10-year period. You can have shorter term things too, but making sure that you're kind of keeping your eyes on the prize. But it can't only be about money. You have to cultivate a connection between the owners and the company beyond financial results. If it becomes just about the money, then you actually get the worst of both worlds. You don't get the benefit of outside capital of a public company, and you get all the sort of stuck shareholder parts of a private company. One really important thing is to carefully manage how dividends are paid. If they're too low, then it makes people start to wonder, is this wealth concentration? Is having 98% of my wealth in an asset that I can't really sell and it doesn't pay me any dividend, is that really worth it? But if it's too high, it can crowd out reinvestment, or actually, you know, lead to a burden the family business can't sell. And this is actually the story of the Wall Street Journal, where the Bancroft family, you know, got into a period where dividends were so substantial and they're funding their lifestyles that when the business started to change, they didn't have enough money to reinvest in it. And then when it came time for someone like Rupert Murdoch with a great offer, it felt like the only way out. Keeping that strong balance sheet, you know, companies go out of business not because they don't have revenue, but because they can't pay their bills. So avoiding the risks that can come with that, and also being ready to be aggressive during tougher times. Most family businesses that I know are reluctant to pay, you know, 9, 10, 11 times earnings multiples on acquisitions. They oftentimes will wait until capital is scarce and they can get better deals. We also have to manage those estate planning liabilities. You know, I've seen this happen with a number of cases where family businesses didn't plan effectively and therefore either had no choice but to go public or to sell the business in order to pay it. And also just making sure that that capital is committed, not captive. So making sure that there is an exit mechanism for shareholders who want to leave. Very, very clearly laid out, one that is fair to the seller, but also protecting those that are sticking around. So the third sort of strategy that I want to talk about is the social capital, about reputation. And you know, there's this, you know, Milton Friedman had this sort of well-known expression that, you know, the business of a business is business, that companies shouldn't really be focused on social responsibility. They should just make as much money as possible and leave that to anyone else. And that maybe that was true when reputations were really built on a one-way conversation between the company and the end user, when you have like relatively few channels, literally in the case of TV, to talk about it, very little feedback possibility. But that's really changed quite a bit. And it's really important for all companies to actually build a reputation that creates trust with customers and communities. And Larry Fink from BlackRock, said it well. To prosper, every company must not only deliver financial performance, but also show how it makes a positive contribution to society. And there's some research done by the Reputation Institute about how investing in reputation will pay off on the bottom line. Again, an area, this is something that family businesses are incredibly good at. And part of the reason why is because when your name's on the door, either literally or figuratively, it creates this personal connection between the family and the community and customers and so on. You care much more about your reputation when your name is behind it. But also because things that are trade-offs in the short run aren't necessarily in the long run. When we think about environmental decisions, yes, you could save some money on towards your quarterly results by cutting corners on safety or environment. But that's going to definitely not pay off in the long term. And in the long term, those things actually benefit each other. There's this reinforcing cycle that the more your company is associated with these positive things, it actually gives you a further leg to your competitive advantage. You can also build trusted relationships with customers, suppliers, and so on. The kinds of things that can only get built over decades or generations. I see many family businesses who see this kind of social capital, this relationship capital, as one of their most important strategic lenses and advantages. And Edelman Trust Barometer looks at how much do we trust different kinds of companies. 75% of people trust family businesses compared to 59% of businesses in general, and 2/3 are willing to pay more for products or services of family businesses. And again, this is actually from a family in Southeast Asia. They say we are able to build stronger trust with our customers as a family company. We have more social capital because of our history. Our name is one of our most important assets. Okay, so I want to shift. Talk a little bit about how do you activate, sustain that advantage. First of all, I've been in a number of discussions where people are talking about the trade-off between profitability and being a good corporate citizen. I think this is actually more often than not, except at the extreme, this is an unhelpful conversation. Being a good corporate citizen, more often than not, it's going to pay off in terms of profitability. So reassess that dialogue and that conversation. Being really thoughtful about your reputation is more and more important. Any one person can, have a real impact on social capital. I think about what happened with LL Bean back in the 2016 election, where one of the owners, just one out of I think 60, basically came out as a Trump supporter, and that triggered an entire boycott of a company that has more of a liberal reputation. And what's important to note is that yes, that was, and this is what the CEO said, that's just one person's voice. But the public is not going to make these fine-grained distinctions between this owner has this perspective, but these owners have this perspective. And so it's really important to talk about the impact that each person can have on either building or destroying social capital. And certainly one of the things I'm seeing, in this day and age is having a social media policy to avoid that damaging publicity. Those key relationships, make sure as part of succession planning that you're actually handing those off from your next generation to their next generation for suppliers, customers, and so on. Proactively making sure you're mitigating the potential for virtual protests. There's a company that we work with that the CEO of the business is actually copied on every customer complaint about a product. They're in the food business. And he said that it used to be that if someone got a defective product, they would just write us a letter, and now they just take out their phone, snap a picture, upload it to Facebook or whatever, and all of a sudden we've got a crisis on our hands. We have to get out in front of those things. And the last thing is just because of the value of family brands, at least consider if your company's brand is not if you're not branded to the family, if you're not branding yourself as a family business, at least ask that question. Sometimes it doesn't make sense, but more often than not, there's real value to associating your business publicly with being a family company. And actually seeing that, for example, Ford Motor Company, some of their recent ads, is actually branding themselves as a family business, which they hadn't done so much before. Okay, so that's the world of capital. Let's talk about decision making. And the priority before, given these huge global operations with far-flung activities and many different companies, the management challenge is what it's about sort of managing complexity. Think about these matrix organizations that used to be popular back when I was studying business. And what's happened now is that it's much more about speed than managing this sort of organizational complexity. And what all companies are trying to focus on is building the capacity for flexibility, adaptability, decisive action, because things are changing so fast. And again, back to George, speed is becoming more important than size, and the basis of competition is shifting from scale to pace or tempo. And what you hear a lot of leaders talking about in the management literature is shortening the distance between decision makers and the front lines. So instead of it going through 5 or 6 layers, I'm trying to reduce those. And this is something, again, family businesses are kind of structured this way. They're structured in a way that used to be kind of criticized by a lot of people, but actually is kind of, people are now emulating, having nimbler, flatter structures, having the ability to make big bets faster than competitors. One of the things I found really interesting is that the CEOs of companies, of public companies, spend a lot of their time talking to analysts, talking to the market. CEOs of family businesses actually can spend their time on strategy, on customers, on all those different kinds of things. And actually, one study that was looking at crisis situations found that family firms have greater flexibility compared to large public organizations. The managers are often only accountable to themselves and their families. And this is from another family business that this is a multi-billion-dollar company, not a small business. No matter how large we grow, I have a flat organization and deep relationships with managers. That means that any of them can get to me for a decision. Speed of response is becoming more and more crucial, and we are able to put large projects to work quickly. It's not so much that family businesses are always more efficient. If you're part of a family business, you know that there's oftentimes you debate and discuss, simple decisions for a long time. But it's the ability to make big moves very quickly that can actually be a big advantage. So how do you sustain that? How do you build that? Making sure that as you're growing, you have clear decision authorities to ensure you've got good delegation in place. There's a risk that you can have too much centralization of power in that leadership in the top, making sure that you're actually delegating effectively. Part of that is actually, as a leader, making sure that you're finding the areas where you can make the biggest difference in company success and staying connected to those. So as an example, there's a large Brazilian retailer that I worked with, multi-billion-dollar company. The CEO of the business would still make the decision for the location and format of every new store they opened. And he said, look, I've been doing this for 30 years. I know in my gut when there's a location that's the right one, when there's a format that's too big or too small. And if we make that decision right, then we can get our team can run that well. If we get that decision wrong, no team can make that store profitable. So finding those areas where you can make the biggest difference as a leader and focusing on those and making sure you're delegating other things. Also making sure that you're creating alignment from the owners to management. As George talks about, a key to speed is clarity about strategy, goals, guidelines, resources, and constraints. The more that you've got alignment, you invest in creating that alignment, the more effective the more quickly you'll be able to act. One of the things that family businesses do a lot is build silos. I'm in charge of this business, you're in charge of that business. I'm in charge of finance, you're in charge of marketing. That actually is a very healthy thing because it creates some space or barriers between family members, helps to manage conflict. But if you silo customers, it can become a real problem. I was talking to one family business and said that each of the family members they were in the wood business, each ran a different varietal business, and said, like, one week I would be at the customers, and next week someone else would be at the customers, the same customers, and so on. They ultimately reorganized to make sure that wasn't happening. And then lastly, making sure that given the pace of change, you're really trying to build loyalty to your organization, to your company, to the broader legacy, rather than to specific assets, to be in business, not a particular business, because there might come a time, and those times are coming faster than before, where a particular business might not be viable. Okay, and lastly, I want to talk about the governance decisions. How do you sort of align the interests of owners and managers? And the priority when public companies were coming up, all the work was basically, how do we separate? How do we empower managers to be able to run the business day to day, get these pesky owners out of the way? And actually the challenge now is trying to figure out, how do you actually make sure that the interests of owners are being pursued by management? Most of you are probably familiar with the principal agent problem, that how do you actually make the the agents act in the best interest of the principals? And this is something that public companies have been working on for decades, and I don't think with a lot of success. Instead of worrying about the external people rating the business, oftentimes the corporate raters are sitting in the C-suite. You look at the way the compensation plans have exploded. You look at some of the scandals like Enron. A lot of the problem is actually sitting in that incentive structure about managers doing things that are not in the interest of owners. And the imperative of ownership is shifted from empowering management to providing at least some sort of check on their behavior. And again, this is an area family businesses can be really good at. First of all, just having fewer owners, even if you've got 200 of them, it's a lot easier to address that problem, to get some collective action than before. But also, they care a lot more. If 95% of my wealth is tied up in a business, the golden goose, I care a lot more about that, about what that does, about what it's doing. And in many cases, because oftentimes the principals are agents, so the family members, the owners are either working in the company or they're on the board. That creates a lot more alignment of incentives between owners and managers. And so, some work that Mark Hudak at NYU has done has talked about the natural governance advantage that private companies have over public companies, and the reason he points to is because, especially on things like compensation plans and executive pay, there's a much stronger interest in outcomes than in the public company, the golden goose kind of phenomenon, this concentration of wealth, and more knowledge because you actually know more about that business than a public company investor. And this is one of my favorite quotes. Is this has happened in a meeting where we were talking about trying to get the managers to do what the owners wanted them to do in the business, and one of the owners said, "It's our money, it's our legacy. Why are we kowtowing to management rather than insisting they focus on our priorities?" So how do you build out this sort of engagement of owners? First of all, you have to create a space. This is a lot of the work that we do at Banyan, is actually creating an owner's room, a space where owners can do their work, the work of ownership, the things that aren't really talked so much about in business school, which is things like developing objectives for the business, hiring board members, developing policies, and so on. So creating that space. And one of the things that's really important for the owners to talk about is that critical dividend versus reinvestment decision, because that's one of the main tools that the owners have to make sure that to create discipline on management by creating some level of constraint on resources that management can access. And if there's no constraint on that, then what I've seen in my experience is that managers don't always treat that capital as scarce because it's not theirs. And they're oftentimes, their incentive programs actually lead them to focus more on building earnings rather than building creating returns on the capital that's invested. Trying to actually create a direct line into the company, it's actually valuable to have family owner employees even when they're not the CEO, so that you're getting some direct understanding what's happening in the business, or at least cultivating relationships with the board and management. Having some owner level dashboard that you actually looking at what do we value as owners, how do we define success, how do we make sure that the company is doing that, aligning executive compensation with your goals. So if you care more about this, about long-term appreciation, don't provide incentives for short-term profitability. And then lastly, actually building up owners to be more professional. Ownership is something that even if you're, even if you have if you're an artist or a stay-at-home parent, you can become an effective owner through education, training, and development. It's actually a really important part of sort of making a family business last successful over time. So let me just kind of, by way of summary, talk about some of the implications of what I've just said. I'm not saying that family companies shouldn't go public or look for private equity. Certainly there are industries that still demand serious capital investment to survive, things like airlines. And oftentimes there are hybrids that are somewhere in between, where you have public ownership, but the concentrated control by the family. Google and Facebook actually, for example, operate that way, as do a number of family business like still Ford or Molson Coors, where the family actually still has control. And that can actually bring some value. And also sometimes an IPO can be a great way to sell a business that's maxed out, or that you've maxed out your ability to grow it and reinvest in other areas. And I would say, because there's work to be done. If you want to sustain these advantages, then selling might be or going public might be the right option, because family ownership, of course, brings disadvantages too. So it's not just all a rosy picture. My point really is that if you are willing to do the work, you don't need to go public in most industries most of the time to compete on the highest stage. And in fact, many companies are actually better positioned for long-term success by staying in the family's hands. And so that's really one of the messages I want to leave you with, is that oftentimes we talk in the family business field about the 3-generation rule, which I think is nonsense. All these reasons why family businesses are doomed to failure. And instead, I want you to at least be open to the possibility that family ownership brings with it the potential to build a sustainable competitive advantage in this economy. And of course, the dangers are real. Change is necessary. It's part of life. but you can succeed despite the challenges that come from family ownership. And in fact, if you focus on building out these sources of advantage, family businesses can actually succeed beyond any others. And that's good news, not just for anyone who's an owner of a family business, but for society as well. Family businesses consistently are shown to be better employers and more committed members of the communities in which they work and live. And honestly, I really believe this, that at their full potential, when they're doing things in the right way, family businesses actually represent capitalism at its best. And with that, I'll come to an end. For anyone that's, we'll go to Q&A, but if you're interested in talking more, my next project is going to be working on this topic. Please feel free to reach out to Josh at Banyan.Global, or you can find me on LinkedIn. Delighted to continue the conversation.
Josh, thanks so much. Thanks for the enthusiastic presentation. Some really interesting questions have come up in the Q&A. I have some questions as well. I'll raise some questions that really cut across some of the themes that are in the Q&A. And let me start with one that's sort of it sort of cuts at a definitional question that Rafi Ahmed asked at the beginning, and several others that Wanchan have sort of raised as well. In sort of where are the bounds of a family business? Because we can think of lots of public companies that still have very substantial both family ownership and family influence. And that's true in the U.S. It's even probably even more, it's just as true or more true once we get outside the U.S. So is Walmart a family business?
Yes. Yeah. And to me, again, I think this is kind of like strategy. You can read lots of different definitions of family ownership. For me, a family business is one where the business, ultimate control of the business is exercised by people that are related to each other, either in the same generation or across multiple generations. Like you can have a family business that passes from one to one to one. I've seen that for 25 generations in a row. But really, it's about control. And so that, like I said, Ford, I would consider a family business. Even though the family has a relatively small share of the equity, they actually still retain the control. And so I would think of those as family businesses. Of course, there's a difference between the full, private family business, which has, I would say, the full range of things that I've talked about, and this kind of hybrids that have some aspects of the benefits that come with the public model and some aspects that come with being sort of the classic private business. And so as you find yourself in between, companies are in between that, they're going to be toggling. They're going to give you some of the benefits of each and some of the cons of each. Okay.
Thank you. That's helpful. So you've laid out some potential benefits of family ownership or family control, at least. Engaged talent, committed capital, trusted reputations. If those are really strong, presumably they'll drive public corporations out of the market, because you've said, the definition of strategy is allocate resources to get competitive advantage. If those three things and others provide a really strong competitive advantage, they should drive other forms of business out of the market. We haven't seen that happen yet. Are we likely to see that in the future?
It's a great question. Well, first of all, I think we have to think about these as, the absolutes. I'm trying to make a point about overall trends. The absolutes in any argument, I think, start to slide. We have certainly seen a reduction in the number of public companies. If you look at the trends over time, that certainly in the U.S., I know that has happened. So there has been a reduction in the public companies. And certainly there are, but I would say there are some industries, and technology is a great example. This is the ones that are drawing most of the attention right now. Those are examples of where there actually are still things very similar to the dynamics that most companies faced 100 years ago, which are about being first mover advantage, about being monopolistic potential. In those scenarios where it's a winner takes all, certainly you should expect that it is still a race to scale. Whoever gets there first is able to have a tremendous advantage. And so in those sectors, you'd still expect that public companies would play a big role. In sectors where it requires still huge amounts of outside capital to survive, we'd expect that public companies are still going to play a role. So it's not that they're going to go away completely. It still, I think, serves a function. It's just the relative emphasis of it. And in particular, it was really, I think, hard for family businesses to compete at the highest level without going public before. I just don't think that's the case anymore. And that's really the focus, rather than we should expect that the public ownership model should go away entirely. It still serves a purpose. It still builds advantage in certain particular circumstances.
Yeah, I'm perhaps less sure than you are that the number of public companies is going down, because if I remember the CompuStat data correctly, which is the listing of public companies, I don't think there's a decline. There might be a shift in composition if your definition of family business includes public companies that have family control. Possibly there's a shift in composition.
I'll certainly defer to you on that, Will.
Yeah. Let me pick up on you've outlined a lot of strengths, and they're and they're really intriguing strengths. Some of the questions that have come up have Cecilia Gu, for instance, mentions that there's research on some of the limits as well.
Sure.
Right. So there's certainly some research that says there's a risk of tunneling in which family businesses, family controllers may shift resources from the minority shareholders onto themselves. There's some research suggesting that maybe family businesses have a longer term perspective, but because they're trying to preserve capital for future generations, may actually be less risk taking, and so miss some of the growth opportunities. So where do you see the bounds of the benefits of family business?
Sure, and some of these actually are I don't think are inherent to family ownership as a model, and more about kind of how you do it. I do think that being a outside investor in a family business, can be a challenge. It can be being a minority investor into a company that's controlled by a group is certainly something that you want to be thoughtful about. I mean, when you think about minority investors inside, if you think about tunneling or taking capital away inside of a family where you've got some, those are in control of management, are kind of taking the rents for themselves. That's something that I think is not inherent. It's something that can happen if you're not careful. It certainly can happen in a public company too. I think it happens all the time. They're called stock option plans. But it's something you have to be sort of thoughtful and careful about. I was talking to one family business recently, a very successful, large one, and one of the criteria that they base family leadership on is actually demonstrated capacity for ethical behavior, because they've seen when family members actually take and capture those things for themselves, that's what destroys family businesses. And Pritzker is actually a good example of that. One of the things that brought that family, among others, that brought that family business empire down was a belief that those that were the triumvirate in control were actually taking these huge bonuses for themselves away from the broader family. So certainly it's an issue. I think it's one that you have to manage if you want a family business to be successful. The point on innovation, I think I've seen some research that suggests that family businesses actually can be quite good at aspects of innovation because they take a long-term view. There isn't necessarily a need for new ideas to pay off in the near term, so there's that sort of long-term orientation. But certainly there's some downsides that can come with that as well, in terms of a willingness to access outside resources. So look, there are things that family businesses don't do well. I'm not suggesting that it's the perfect ideal form of capitalism, just that the things that I think are becoming the more dominant forces of success are shifting towards things that family businesses are good at. And the things that are, were previous, like the sources of capital, are becoming they were not as good at, are becoming less critical on a relative basis.
Okay. And can you dig in a bit more to potential conflicts and how you resolve potential conflicts between family owners and non-family owners? Because certainly many family businesses, once they get to any size, in order to raise capital, need a broader base of investment than simply the family. And Rafi refers to this, as he says in the note in the question, as the second agency problem, the conflict between family and non-family owners, as opposed to between owners and managers. How do you, in your view, how do you resolve that?
Well, I mean, I think that's something that certainly, can be a challenge. I'll be honest, a lot of the family businesses, even multi-billion-dollar companies, 10, 20, 30 plus billion-dollar companies, are very careful about not accepting outside equity. So I think partly this is, this is a choice of capital structure, and one that, the model towards becoming larger in family businesses is in general, through retaining most of the earnings and growing over a period of time and those things. So I'll be honest, I have less experience in actually seeing capital structures. In fact, a colleague and I did a study of 100 family businesses, and 90+% of them didn't allow any outside capital whatsoever. So I think when you're talking about a public company, I think that gets you into, with outside investors, I think that gets you into a certain realm of corporate governance and so on, I think is relatively well explored. I think if you're talking about being outside investor in a family-controlled business, I don't know that that universe is huge. It's not one that I've certainly can give you a lot of evidence because I haven't really seen that much of it.
Okay. So this will probably be the last question because we're coming to the top of the hour. I want to reflect a bit on US, or sort of non-US settings, especially in emerging markets. Much of the growth around the world is happening in emerging markets, and that's post-COVID, that's going to be accelerated in all probability. And many of the businesses in emerging markets are either family, and even the public businesses have big family elements. What are we likely to see in India, in China, in South Africa, in the many settings in which this is true?
Yeah, so I actually have done a lot of my work in non-US settings, and I think some of the times when I've given this kind of conversation, the answer is, well, duh. I mean, of course, family businesses bring advantages, for us, and that's in part because there's a lack of capital market alternatives for them, and I think one of the things that you're seeing in a number of countries that are emerging, and where these companies are getting to a level of scale, they're getting beyond the founding generation, the second and third. Is actually this whole question of, should we stay private or should we go public? And if we go public, can we do that in a way that allows us to retain control and gain some of the benefits, of being a family business? So that's a lot of where I'm seeing the conversation going. I think family businesses, when you don't have developed capital markets, a lot of these advantages are actually even more amplified. And if you think about social capital as being not just your reputation, but your relationship with governments, politicians, and all those kinds of things, those being a strategic advantage, I think actually the argument is actually quite a bit stronger. And I think what we're seeing is actually in emerging markets is companies going more towards some of the middle ground that advanced industrial companies have found of how do you use going public, partially public, being a hybrid kind of structure, how do you use that to kind of build on what you've already created? And still retain the things that sort of work well as a family company.
We lots more questions, lots more comments, lots more interpretations. We have hit the top of the hour, and I think in respecting people's time, I want to say thank you so much for your time.